Joining us right now is Priya Misra, who is Global Head of Rate Strategy at TD. And Priya, this has been the question people have been trying to figure out all year, even longer than that. Where are rates headed? You got to know what the Fed is doing next. And there have been some pretty conflicting signals on that front. Where do you think we're headed?
So I think the big macro question is the data strong because the Fed is not restrictive enough, or the lags have just not worked through? We're very much in the lags, view. I think if you look at interest rates, they became restrictive, I would argue, in December last year. I mean, we're 2 months out. It takes a while, 12 to 18 months for the lags to kick in. I would argue that that Fed policy is restrictive already, and the Fed's going to continue to hike. They might stop somewhere between 5.25, 5.75. Maybe they have to go a little bit higher, I think, essentially in 25 basis point increments. I think what the market's done is looked at the strong data and extrapolated it, and essentially, assume that we're going to have no landing, soft landing. I would argue the long end is very attractive, because the only way to get inflation down to 2% is for the unemployment rate to go, I think, close to 5%. I think the Fed has no choice but to engineer a hard landing. So these long end treasuries, fives, tens, I think they're very attractive, because you've got to position for that eventual slowdown. So we're long tens here. I would just stay away from that very front end, because the data is still strong, and I think the Fed is going to feel that pressure to continue to hike.
So if you think a hard landing is coming, when do you think that happens, and how quickly do you think the Fed pivots? I mean, you'd be in the camp of people who have been saying rates shouldn't keep pushing up from here because the Fed's going to have to do an about face.
Right. So I think, this pivot is going to depend not just on growth, it's going to depend on inflation. Our view is that inflation is going to be sticky. So I think they can stop hiking somewhere in the fall. I think to actually turn around and start to cut, we're actually thinking that's only happening next year. They're going to want to see inflation getting close to at least have a two handle, 2.8, 2.9. We're pretty far from that. So they may not pivot. And I think the market's going to get really nervous, because we're going to see potentially negative job growth numbers. So, to your point on when that happens, we're thinking third quarter, fourth quarter. And really what's keeping the consumer going is this accumulated savings. The savings are coming down, but at some point those savings run out. In our view, that happens by the middle of the year. And then interest rates bite. I keep hearing from investors saying interest rates don't matter. They matter. Once you don't have that savings buffer, you're dealing with car payments, mortgage rates moving up. That's going to start to hurt. I mean, that's how monetary policy works. But it's just going to take some time. I think actually the economy needs time. It doesn't need more rate hikes. But this Fed is data dependent. So I think they're going to continue to hike until they see signs of that inflation number is starting to come down.
So when the economy really turns down, when this hard landing hits, when there's a recession, it's led by consumers not spending anymore on all the stuff they've been spending on, whether that be at the retailers, whether that be traveling, across the board. You see that kind of collapsing?
I think goods spending has already started to come down. I would say service spending is what we're watching. So ISM services comes out today. I think that's an early read. Do you start to see some pullback? We were all cooped up for a couple of years. So I think there's been some reopening related demand for services. When does that start to come off? My savings buffer is going down. Financial conditions are tightening. Do I start to cut back on service spending? I think goods spending is already declining. But yes, exactly our point. We expect the consumer to drive this lower. We're not looking for a really severe recession, but once that service spending starts to come down, I think the job market starts to slow down as well.